All right, welcome everybody. All right, so first and foremost, I mean, from the bottom of our heart here at Professional Planning Services, we want to wish and hope all of you had a happy new year and that 2023 is a great one, a prosperous one, a healthy one, and that you really are able to get the one and that you're with the ones you love and love spending time with. So I do appreciate all of you taking time out of your weeks. This has taken on sort of a direction that I never really thought that it would continue, but just with COVID, it's forced us to reinvent how we communicate with the public. And one of our strongest belief systems is educating the public. Now, this week we've come off the holidays, and last year we did a similar event, and we had a good response. So we reached out, and some people typed in some questions. So we have some pre-populated questions for Ask the Financial Planner, and then at the end, if there's a question that you want along the way, please type it into chat. And if I know the answer, I'm happy to share it. If I don't, I'll research it and get back to you, and we'll go from there. Lastly, again, I just want to thank you all. And if you ever need me for anything, let me know. Without further ado, who besides a financial planner should someone have on their financial team? For example, let's say an accountant, a tax advisor, etc. How, if at all, do they work together on a client's portfolio? And does it matter if they don't all work for the same company? Lastly, what are the typical costs to engage in these additional resources? Well, I could spend the next 15 to 30 minutes just on this slide alone, but I'm going to give the very obvious answer, which is legalese. It depends. Everybody's circumstances, and this is why we have to be careful, right? So we're going to start with do it yourself. Can you do it yourself? Can you plan your future for yourself? That's the first question, and only you can tell. If you don't have an overly complex estate, and nobody in their earning years really thinks that anything can go wrong. But I will share with you an unfortunate advisor colleague of mine over the years, 44 years old, I found out last week, passed away, right? Has left 3 kids. He's in my industry, was on a family trip down in Tampa and had a heart attack. Guy was healthy. I knew Kyle for a long time. And it just saddens me, right? And it makes me look inwardly as to, are my affairs in order? What happens if today is my last day on the planet? Have I dotted my I's and crossed my T's? And that's really what this question is all about. See, there are some components which, as an accountant, right, that's taxes and tax returns, and and are we doing it ourselves? Did we use H&R Block? Did we do Quicken or Intuit or TurboTax? Any of those things, right? Those would be options. And if something was amiss, would it affect your estate? Now, depending on the size of the estate, probably not. But it's always good. One of the things that I was thinking about with this question, besides a financial planner, one of the things I view myself, I've always strived since I've stepped into this arena, and as I've educated myself, worked with folks along the way, really what I've tried to position myself to is that trusted advisor. See, I don't need to make a nickel on everything that everybody does. What I find works best for me, it helps me to sleep at night, it helps me to build friends and relationships, is being the person that's going to tell you what you need to know, not what you want to hear. Not me trying to pad my pocket because I'm making an extra penny somewhere or nickel somewhere. And I find that those types of folk are few and far between, right? So a financial planner, depending on their skill sets, depending on their background, depending on their experience and their core, could be one person where it could be, different than how I am. Maybe, I've had folks contact me last year. I remember a folk saying, he says, I already have a financial advisor, but you've intrigued me with something. It's in the book that I wrote, Wealth Beyond Taxes. He says, I've never heard of LERP. I've never heard of Kaizen. And I'm not telling him to end his relationship with this financial advisor, but what it allows us to do is to give people a second opinion, right? Now, I am not a CPA. right? So I am not going to sit here and second guess tax returns. However, I can offer tax strategies. See, typically accountants are historians, and they're going to look at, your past year, aggregate all the data, and at the end of the day, typically the advice that they give is you owe what you owe, and there's not a lot you can do on a go forward. I tend to disagree with that philosophy. I think with proper planning, being strategic in our approach, that there are things that we can do, especially if you're a high income earner, right? That if you're earning over 150, 200,000, there are strategies that you can start to do to mitigate risk in the future, and that's tax risk. All right, so how do they all work together on a client's portfolio? Well, again, portfolio management, that could be the person that's coming in once a quarter at your work, and that person could call themselves, I'm a financial advisor. So it gets very confusing, right? My accountant's a financial advisor, Chris is saying he's a financial planner, and this guy that walks in once a quarter, I don't even get any return phone calls from him, but he does it because he has to, right? And he's telling me that I should do a 60-40 split, right? I'm not going to disagree with him. I will point out that inherently 401ks, TSPs, IRAs, 403bs, TSPs, and 401ks tend to have exposure because of lack of choice, or people when they tend to book, strategies or follow traditional wisdom could inadvertently or unknowingly make mistakes that they probably could have avoided just with education. So what I find is education first, and it's really important. And does it all matter if they don't work with the same company? And the answer is no, right? Because at the end of the day, I can tell you that over the years, as I've gotten to know folks, I typically will ask for a data sheet saying, hey, this is our intake sheet. This is some initial data. I typically like to keep things on a very low. We don't need sensitive data. I don't need Social Security numbers. I don't need tax returns yet. Where I will challenge folks is I'll say, hey, I do ask you to look at your spending habits, right? Because I am a comprehensive financial advisor. When I share that with folks and I say, hey, listen, quite often when I do finally get the comfort level from a client that, hey, listen, I'm going to share the tax return with you. Again, it's sensitive data. I'm not going through line items saying, hey, this accountant missed this or missed that. What I'm trying to do is be, again, that trusted advisor, part of the team, to help make sure that, hey, listen, where we're at today, can we forecast into the future where you want to be? What's your end game? What's your goal? Where are you trying to get to? And are you doing so in an efficient manner? And then lastly, what could go wrong? Everybody will always point to something and go, I want to see worst case scenario when they're looking at something. Yet quite often they'll take it at face value that the tax return that they just got back from their accountant, their CPA, was all they could do. And again, quite often there are little things, little tricks. The tax code is complicated, that the adjustments they could have made. Now, lastly, what are the typical costs? That is all over. And again, it depends. You go TurboTax, you do it yourself, it's whatever the fees are, right? You go to a local accountant, we have a tax preparation company that we own, Easy Pro Tax, that we do for some clients when they want it just for ease. We've been doing that for years. Typically it's, it's not a profit center for us. It's done by CPAs, and we package up the documents and send them to the CPA, get it all done. If you wait to the last minute to hand them to us, I can tell you you're going to get asked for a delay, right? So it's going to wait until after April 15th. But if you get it to us by the end of February, typically we'll get it done, and it's anywhere from $200 to $250 depending on the complexity in states. So anyway, those are some of the costs. Some of the more I've seen my taxes last year, $3,000. Right, a lot of money. So I farm mine out to a CPA firm in Colorado. I have some complex taxes, so everybody's situation is different. All right, so hopefully that answered that question. All right, this came in from one of our clients, and Brookstone is my RIA, registered investment advisory firm. That's who I run all my portfolios through. And sometimes in those portfolios, we do have independent stock holdings. And what this person, they will remain anonymous. But I knew there was a story about it, so I called them and asked, and they said, yeah, is Walgreens in my portfolio? I said, yeah. Why? Because it is. They got a pretty good dividend paying history. He goes, well, they just aggravated me and I don't want stock. I said, okay. All right. So, listen, at the end of the day, it's your money. We'll do with whatever, depending on your portfolio. So we did. We started to take steps out of their accounts to move and liquidate and invest elsewhere. So, again, this is, can it be done? Yeah, you just got to let us know. Typically, when you're going to see when selling a stock, you typically got you can put in the sell order depending on when you get a hold of me, when I get a hold of my RA, and by the trade goes through. You got to allow a day for the trade to be acknowledged. And then there's what they call T+3, right? So trade +3. So they then will put in a request. Now ETFs typically will happen. ETFs are exchange traded funds. If somebody calls and says, hey, listen, I want to adjust my portfolio, that will typically be at the end of the business day. But everybody's portfolio is a little bit different. But I always say, hey, allow for T+3 for us to move X amount to cash, and then we can decide about reinvesting from there. All right, so stocks have been taking. Is now the time to buy, right? So very broad question, very subjective. And I can tell you, if you Google timing the market, you will have endless research, opinions, and actual factual confirmation that you can't time the market. As soon as you think now is the time to buy, is when the market continues to drop. As soon as you think now is the time to sell, is when the market turns around and goes on a rally. Timing the market is a fool's errand. Again, many sophisticated institutions have done pretty deep dives on this to prove that point. But one of the strategies, and this is why 401ks are so attractive, because they automatically put in a mechanism called dollar cost averaging. So when you're able to put money in weekly, every 2 weeks, once a month, regardless of the day, now you're buying and you're starting to smooth those extremes. But I did want to show a slide just to show folks that, as the S&P is, as the S&P I talk about, is an index of blue chip stocks here in the United States. And this is, a 120-year graph talking about periods of time and when fall-offs happen. So, my question is, and I'm going to move my mouse. Let's take this here in the Great Depression, right? Suppose you thought right here was the time to buy, and the market started coming in, you jump in, and then the bottom fell out, right? This is an enormous loss, which took 25 years to recover. You cannot time the market. Now, if you weren't retiring in this period of time from 1930 to 1932, right, you could have dollar cost averaged all the way down. So as this stuff and your dollar cost averaging on the way up, eventually that's how you make money. But when we look at, and this is not current, right? It's a couple years old, but I thought it was still a picture's worth 1,000 words, that even with the housing bubble burst, even with the internet bubble burst, right? When 2000 or 2008, right? These cliffs, in comparison, we have an overall upward trend. Right, we have some volatility in here of late, but I think that this puts, in perspective that there's a lot of unknowns. Could things correct? Could things go south? I have no idea what things could cause, a contraction. Well, a war, right? A depression, right? Things that we haven't seen in our lifetimes are things that we should be careful of. But what I don't like to do is panic and go, hey, the volatility. But listen, it's always your money. And whatever you decide to do, you're the one that has to be able to lay in bed at night and not have your eyes open, staring at the ceiling going, I'm nervous. So I wanted to put that slide in there as a point, and it's a good segue for the next slide. Right? If you're at a point where you're feeling like, hey, I'm getting close to retirement, I don't want to have sleepless nights. I want to be able to feel confident that we can preserve. As we remember, retirement, I have a designation after my name, RICP, Retirement Income Certified Planner. That means I'm an expert, not just getting you to retirement, but through retirement. And during the course of our evaluation, what we will help people to start to forecast and look at is what could go wrong. And it's looking at some of those events that could happen, not just market risk, but tax risk, health risk, inflation. All these things are factors that can affect the bottom line. Because remember, if you don't learn another thing from us, retirement is about income. It's not how much money you have. It's not about the number. It's about what is your lifestyle? What is your, how much is the money coming in, right? How much do we have coming in, right? So that could be once we hang up our cleats. I just had a call yesterday, 2 days ago, with a client I've been working with for 5 years. Hung up his cleats and retired. Congratulations, right? So what gives me great pleasure is knowing that they don't have a red line. So we're going to start talking about in the future some of the tools that we have and how you can start to take advantage of looking at your specifics. And if you want access to that, right, how to do it. And again, if there's ever a cost to deal with this, I must, as a fiduciary, tell you well in advance. But with that said, there are still, sometimes people, and during this course, it's always your money, will say, hey, where can I put my money somewhere that I won't lose anymore until the market rights itself? So depending on where you have money, let's talk about our options. The first is cash. You could take cash and put it in your mattress. That in and of itself has risk. People don't think it has risk, but it does have risk. There's physical risk, right? You could have rats eat it. You could have a fire burn it down. You could have water damage. It could be stolen, right? So that's dangerous. However, in the Great Depression, quite often that's what a lot of people did. Now, the term, this is a little known fact, the term cold hard cash came from when people were scared of banks and the financial institutions, they would take their money and put it in their freezers. And the reason they would put it in their freezer is if the house burnt down, the cash was still safe. And that's where that term cold hard cash came from. So a little bit of trivia for you there, but so that's one option, cash, right? Now, banks, which is really, from a societal standpoint, has become that sort of go-to. But I don't know if you've looked at some of the signs around lately, but, in the last 2 or 3 years, I mean, interest on some of these CDs, checking accounts, savings accounts, if not zero, 25 basis points, a quarter of a point, maybe a half a point. Now you drive around and they're shouting, we got a 2% CD for 3 years. Okay, let's understand that depending on the environment that those CDs are held in, you still got to pay taxes on it. Every year you're getting a 1099. So you don't net. I don't care what the interest rate is. When you put the money into a bank in a CD, even though inflation is upon us, even though rates are rising, even though there will be opportunity at the banks, you're still going to get a 1099 at the end of the year, and that is tax risk. All right, so that is another option. One of the areas that I like, I'm partial to, or something that I've talked about in the past, and I'll talk about it again, I've started doing a monthly update. It's called MYGAs, MYGA, which stands for multi-year guaranteed annuity, right? Now, I just did a video that I sent out to our client list that said, hey, for January, I just got notice that the 2-year MYGAs guaranteed, you put in 100 grand, you get back 4.3% 2 years from now, right? So that's the rate of return on a 2-year. For a 3-year, that's 5%. Now, I will tell you that we only deal in A- and better companies. There's a couple companies. I just heard yesterday, one of my advisors called me and said, hey, this company had a B triple plus. She was comfortable with it, was offering for a 3-year 5.6%. I don't chase return. I like safety. I think B triple plus is fine. But I just know most of advisors, their E&O won't cover it. So I try not to play in that arena. All right. So with that said, a MYGA multi-year guaranteed annuity is something that I think if you have some short-term cash, but I just looked up today, there's a company, one of the only companies I know of that has a 1-year guaranteed MYGA. Now, the way it works is it's 1 by 4. You put it in for 1 year, you have 30 days to take it out, and it's penalty free. And right now, I think that's 3.4%. And remember, at the interest on that, at the end of the year, if you roll that into another annuity, and that's if it goes from an annuity is tax deferred. So we're not paying the tax at the end of the year. So we get the full growth of that money until we're ready for it, right? I just think it's a very efficient way and a smart way to save and protect our money. It's not talked about much. You're going to hear me talking about this book here in the future. Patrick Kelly is somebody I did a video on, but he talks about some of the safeties of fixed index annuities and MYGAs. The first chapter, if you want a copy of this, send me an email. I'll make sure to get you a copy, no cost to you. You can do your own research. At least the only thing I request is if you're going to ask for this book, and I'm going to send it to you, and it's going to cost me $6, $7, $8 to send it to you, plus the book cost. I'm doing that at no obligation to you. I ask you to at least read chapter 1, right? So we'll talk more about that in the future. All right, so now let's see. I think the next one, any other questions? I did see something come up in chat, so let's see. Exactly on timing. Just read of a Fed employee of 34 years, just retired, and always contributed to the TSPC fund from the start. He never looked at statements. He moved the funds around. He just retired with 2.7 TSP account. I wish someone would have told me that 25 years ago. And there you go, case in point. If you're consistent, right, and you don't listen to the talking heads on TV, Bruce, you're absolutely correct. And I could not concur more. And that's what we do. Part of our job and responsibility is helping to manage emotions. We're emotional creatures. We're not robots. Obviously, in a perfect world, if we were all robotic, we could make perfect decisions and we would never have to worry about anything because we had no emotions. But we are human beings. We do have feelings. We do have to live life. And what happens if, again, something doesn't go according to plan and you need to adjust or adapt? So those are the things that we can help you with. So we just wanted to say, hey, thank you. These are our disclosures. Again, this is all stuff that's been approved. If you have any questions, we can help you in any way. This is our contact information. The last thing I'll leave you with is that we hadn't had a call in a couple of weeks. If you hopped on and I wasn't here, I apologize. I was taking a break. I will have a call next week. That should be the market update. We will continue to do that every second or third week of the month, talking about what has happened. So just keep in mind, really, the market update for this month is going to be last year, which it's going to be a snapshot. In 2023, there's some still storm clouds ahead. So I'm going to tell you what I see based on my research and experience. And then, but as we continue, we're going to be bringing a lot of content that is really important. We're getting ready to do a live event, on Medicare. A lot of people, as they approach retirement, have questions about Medicare, and then how's Medigap work, or Medicare supplement insurance. And so we're going to do a class that we're going to start over at Mercer County College. I think first one will be the first one. That'll be a live event, and it's just educational. We're not selling anything. But the point is that these things are, as a transition into retirement, items that you need. Having expert guidance, I think, can help you along the way. I want to say again, Happy New Year, everybody. Thank you all for your support. Please don't keep us a secret. If we can help you anyway, please let us know. Thank you.